Okay, thank you all for being here. I'd like to call this meeting of the Council to order. Before we turn to today's agenda, I'd like to note that this is the first public meeting of the Council for many of us, specifically me. The Council is an important venue for all regulators to come together, discuss pressing issues affecting financial firms and markets, and collaborate on the best path forward. I intend to continue to use the Council to help ensure that our financial regulatory system is both effective and efficient. And I'd like to thank the other Council members for their continued engagement and support in this process. With that, let me turn to today's agenda. We have 3 items to cover. First, we will vote on revisions to the Council's FOIA regulation. Second, we will vote to approve the minutes of the Council's meetings on September 22nd and 29th. And last, we will hear an update from the Federal Reserve on the work of the Alternative Reference Rates Committee and from the OFR in efforts to collect data to support alternative reference rates. Let me note that we have some people participating. Do we have the telephone connected in here, or that was... I think we have some people who may be connecting remotely or are not with us. That's Chairman Clayton, Chairman Giancarlo, Director Berner, and President Dudley. With that, let's turn to our first agenda item. On our first agenda item is a vote to approve the revised Freedom of Information Act regulations for the Council. Last year, Congress adopted amendments to FOIA. Those amendments required federal agencies to enact changes to their FOIA regulations. Last November, the Council issued an interim final rule reflecting those requirements, and today we are voting to approve a final FOIA rule. This is an important piece of housekeeping to ensure that our FOIA rules stay up to date. So let's proceed to the vote. Is there a motion to approve the resolution approving the Council's final FOIA regulation?
I move.
Okay. Is there a second? Second. All in favor? Aye. Any opposed? Okay, thank you very much. Any abstentions? The resolution is approved. Okay. Okay, let me move to the minutes. Our next item is to approve the minutes. Are there any questions on the minutes? Okay, is there a motion to approve the resolution approving the minutes of the September 22nd meeting? Is there a second?
Second.
All in favor? Aye. Any opposed? Any abstentions? The resolution is approved. Is there a motion to approve the resolution approving the minutes of September 29th Council meeting?
So moved.
Is there a second?
Second.
All in favor? Aye. Any opposed? Any abstentions? Thank you very much. The resolution is approved. Okay, our last agenda item, as I mentioned, is the Alternative Reference Rates Committee. Let me introduce David Bowman from the Federal Reserve Board to provide the update. And after David's presentation, Stacy Schreff from the Office of Financial Research will present on efforts to collect data.
All right. Thank you for the opportunity to provide an update on the work underway in reference rate reform. As you know, although the FSOC has long endorsed the goal of strengthening LIBOR, it has also warned of the potential risks surrounding LIBOR and has encouraged work aimed at identifying alternative reference rates and promoting their use where appropriate. In July, Andrew Bailey of the UK Financial Conduct Authority, or FCA, publicly discussed the risks facing LIBOR. The Federal Reserve and other authorities have worked closely with LIBOR's administrator to strengthen these rates. But Andrew noted that, despite these efforts, the FCA has had to exert significant effort to keep banks on the LIBOR panels. These efforts to strengthen LIBOR have been hampered by the fact that there are very few transactions in the underlying wholesale funding markets that LIBOR is meant to represent, making banks understandably reluctant to offer judgment on the cost of borrowing in markets that they are not very active in. Recognizing these stresses, Bailey announced that FCA was seeking an agreement with those banks to stay on voluntarily through the end of 2021. The Federal Reserve and CFTC have supported this approach. Under European benchmark regulations, FCA could compel banks to submit to LIBOR for a period of only 2 years. And so this voluntary agreement provides the longest period of time in which LIBOR could be guaranteed to remain stable. Of course, LIBOR could remain viable past this endpoint of the voluntary agreement. But the facts laid out in Andrew Bailey's speech suggest that it is not prudent for market participants to simply assume that it will. We've seen submitters leave other benchmarks such as Euribor, and last summer we saw BNP Paribas choose to leave the US dollar LIBOR panel. We've also seen reference rates, such as the Swiss unsecured overnight reference rate and ICAP's federal funds open rate, come to an end. The time gained by FCA's agreement will need to be spent in engaged preparation. The news from FCA makes the work of promoting robust alternatives to LIBOR all the more urgent. Fortunately, we are not starting from scratch. As noted in slide 3, the Federal Reserve convened the Alternative Reference Rates Committee, or ARC, in 2014 in cooperation with the U.S. Treasury Department, the CFTC, and the Office of Financial Research. The ARC was asked to identify potential alternatives to LIBOR, develop plans to promote the use of those alternatives, and to recommend best practices for contract robustness. After drawing up an initial set of plans and preferred rates, the ARC formed an advisory group of key end users in 2016 to provide input to its final decisions. As noted in slide 4, following an extensive consultation and consideration of a wide set of potential alternatives, in June, the ARC selected a broad Treasuries repo rate, the Secured Overnight Financing Rate, or SOFR, as its recommended alternative. A significant majority of the advisory group also preferred a repo rate. SOFR will be published by the Federal Reserve Bank of New York in cooperation with the Office of Financial Research, beginning in the second quarter of 2018. It will include both tri-party and cleared bilateral repo transactions collateralized by U.S. Treasury securities and will be the broadest measure of this market available. Data for this year, shown in slide 5, indicate that it would have an underlying activity of over $750 billion a day, representing by far the largest volume of transactions in any interest rate market at a given maturity in the United States. As the broadest repo rate available, SOFR is positioned to adapt to incorporate other sources of Treasury repo trades where appropriate, if the market evolves or as new data sources become available. The ability of the Office of Financial Research to collect data under its rulemaking authority will help to ensure the stability of the rates production and its ability to expand to incorporate new sources as warranted. SOFR tends to trade a few basis points below overnight unsecured rates, such as the Fed funds effective rate. But as can be seen on slide 6, like the Fed funds effective rate, SOFR tends to trade in the middle of the range of money market rates, lying between the Federal Reserve's IOER and ONRRP rates. SOFR also generally trades in the middle of the range of other available repo rates. Financial contracts referencing SOFR would be based on an average of the rate over a fixed period of time, such as a quarter. A 3-month average of an overnight Treasury repo rate, such as SOFR, shown on slide 7, is actually quite close to the comparable average of the effective Fed funds rate. It is less volatile than 3-month LIBOR and closer to the Federal Reserve's monetary policy target than 3-month LIBOR. Importantly, for non-financial firms, it is also closer to 3-month non-financial corporate funding rates than 3-month LIBOR. As can be seen on slide 8, non-financial CP rates in black are closer to risk-free rates such as OIS or SOFR. The OIS rates are shown in blue. Than it is to LIBOR, shown in green. The ARC has judged that SOFR would be more robust than a rate based on unsecured markets, which tend to be driven by arbitrage trades and involve a relatively limited set of counterparties. Given the magnitude of the transition that will be necessary if LIBOR does stop, it would be prudent for market participants to consider the long-run prospects of the alternative they use as a replacement for LIBOR, choosing a highly robust rate and not simply whatever seems to be closest at hand. Nobody should want to have to go through this process again. and in choosing SOFR, the ARC has chosen the most robust rate available in the world. ARC members have also been engaged in addressing the key financial stability risks to existing contracts that reference LIBOR. As noted in slide 9, the Financial Stability Board's Official Sector Steering Group, which Governor Powell co-chairs with Andrew Bailey, requested last year that ISDA, a member of the ARC, work on incorporating better fallback language regarding LIBOR into its documentation. The current definition of LIBOR embedded in ISDA documentation specifies that agents should seek quotes from either London or New York banks if LIBOR is not published. In the event that banks are unwilling to quote a rate, which seems quite likely, then the documentation does not specify what over 100 trillion in financial derivatives would pay or receive. That uncertainty would create potential legal challenges and payments disruptions, and those disruptions would be even greater if there were no viable alternative that market participants could quickly move to. ISDA has taken up this work and expects to update its definitions and offer a protocol to allow users to build this more robust contract language into their legacy contracts. It is anticipated that the primary backup in the new ISDA documentation will be based on SOFR, incorporating a credit spread. This work is crucial in ensuring financial stability in the event that LIBOR does stop publication, and it will be important that the protocol receive widespread take-up once it is available. As requested, the ARC has also developed plans to promote the use of SOFR in derivatives and to thereby develop a term market based on this new rate. As outlined in slide 10, under the ARC's proposed PACE transition plan, the goal is to move over time price alignment interest, the interest rate used in determining payments on collateral posted to CCPs, and discounting to new trades to SOFR, which should encourage activity in futures and swap markets referencing this new rate. The ARC has set expectations for the timing of each step of this plan, shown on slide 11. The first step, the development of infrastructure to trade futures and OIS contracts that reference SOFR, is already underway. Indeed, the Chicago Mercantile Exchange has already announced that it will create a futures contract based on SOFR. If market participants work together collectively, the remaining steps of the PACE transition plan can be completed over the next 3.5 years. Assuming that these steps are successful in creating a liquid derivatives market, the ARC believes that it would be feasible to create a term reference rate based on these markets by the end of 2021. This would help facilitate a transition for many end users of the cash products that also reference LIBOR, such as corporate loans, floating rate notes, and securitizations. The ARC's PACE transition plan and the work by ISDA have both centered on derivatives because they constitute by far the largest gross notional exposure to LIBOR. However, as noted in slide 12, the news from FCA has caused many participants in these cash products to recognize their own risks in using LIBOR and to more seriously consider the need for their own transitions, which has necessarily widened the scope of work that will be required. Many of these cash instruments have similar problems and fallback language to that in the ISDA definitions, and we are working to catalog these issues and to develop strategies to address the risks that they may pose. In order to aid these efforts, the ARC will expand its membership to incorporate a wider set of end users and trade groups into its work. A proposed structure for this new version of the ARC is shown on the final slide. This structure should help coordination as market participants now consider the wide array of loans, debt instruments, and securitizations that also may need to move activity to the new rate, or a new rate. This will be a large undertaking, but it will also provide opportunities to develop a stronger financial system based on a more robust reference rate. In many cases, firms use LIBOR because it was easily available and liquid, not because it was particularly well suited to their needs. But many products, including certain non-financial corporate and consumer products, could be better suited to this new rate. We believe that the ARC's plans will materially lessen the risks to the U.S. financial system around LIBOR. These next 4 years will be crucial in ensuring that this is the case. The ARC will need the active engagement of market participants in order to ensure that transitions can be safely enacted, and it will need the continued support of FSOC members. Thank you.
Dick Berner could not be here today, and so he asked me to update the council on the OFR's bilateral repo collection initiative. For several years, the council has called for better insight and transparency into markets for securities financing transactions. And as you know, these wholesale funding markets are critical to the functioning of our financial system. 4.5 years ago, Dick promised this council that we would act to close these data gaps. And so at the Federal Reserve Bank of New York, we did a pilot collection that informed how we would fill one such very important gap, the gap in bilateral repo transactions. September of last year, Dick consulted with the council on our plans for a permanent repo data collection. Today, in collaboration with the Federal Reserve Bank of New York and the Federal Reserve Board, we want to update you on our progress. On behalf of the whole OFR team, including Dick, I want to thank President Dudley, Governor Powell, and Chair Yellen for their support and collaboration. So we intend to collect data in 2 stages. The first will focus on cleared repo transactions. We intend to issue a notice of proposed rulemaking on that cleared repo collection in the first half of next year. And the second phase will come later and collect data on uncleared bilateral repo transactions. These collections are critical for 3 reasons. First, they're going to fill a major data gap in securities financing transactions. From our data pilot, we estimate that bilateral repo activity constitutes about half of the repo funding of major dealers and the majority of the funding that dealers provide to others. Monitoring the tenor, haircuts, and rates in such repos across a broad range of collateral will help us understand the functioning of and spot stress in asset and funding markets. Second, and as David has just discussed, the interest rate information that we collect on the cleared repo transactions is critical to the production of the secured overnight financing rate, the SOFR, that has been selected by the Alternative Reference Rate Committee as an alternative to LIBOR. The cleared repo data will be used immediately in the production of that rate. And later, collecting data on uncleared bilateral repo transactions will ensure the availability of comprehensive data for rate production as our financial markets evolve. Third, and finally, by shedding light more broadly on the specifics of repo funding, these collections will support other FSOC initiatives, including providing us a better understanding of the dynamics of liquidity in the all-important Treasury markets. And so with that, Dave and I are happy to take questions.
Great. Are there any questions from the council? Okay, thank you. Thank you very much for both those reports. That was very helpful. Before we adjourn, does anyone have any other business to raise? Okay, thank you. Can I have a motion and a second for us to adjourn the meeting?
So moved. Second?
Thank you very much. The meeting is adjourned.